Hello and welcome to On the Money right here on WDBO. Hope we're all well fed from a wonderful Thanksgiving. Hope we all had something to be thankful for and got to see some family and friends if possible. So now it is time to transition from the filling your belly mode into the filling your mind mode with all this financial advising, because we are here with the Certified Financial Group as we have been on the air for years and years and decades on WDBO. We're so fortunate to be joined by Joe Bert and Chris Toadvine. Gentlemen, how are we doing today?
Doing well,
great.
Josh. Good morning.
With you. Hopefully your Thanksgiving was enjoyable as ours was.
It certainly was. You always get a good time to see some family you don't see too often, and of course, those pies.
Yeah, there we go. Well, it's hard to believe another year is winding down, so we thought we would take this opportunity to look at some of the opportunities that our listeners may have for year-end tax planning. So the topic of the day is year-end tax planning. That's hard to believe another year's coming to an end, isn't it, Chris?
Yeah, it's hard to believe here we are, Joe. You know, the next big holiday, you know what it is. We're counting down the shopping days already. Yep. So it's time to get started, I think, for those of us who haven't. But yeah, we're looking at year-end. And as you know, at year-end, there are some planning things that, you know, we close the books on one year and we open them on another here in a short month or so. So some things we need to be thinking about.
For sure. So where do you start? So here we are at the end of the year. You've got some things to consider. Maybe looking at your overall investments and see if there's some opportunity to do a little trimming there or some adjustments.
That's right. And so, you know, the first question that I think we need to think about, Joe, and I think we talked about this time last year, but the first question is going to be, do you have any unrealized investment losses in your taxable account? So this, you know, what's a taxable account? It's not an IRA.
First of all, what's unrealized?
Well, there you go. You beat me to the punch.
There you
go. What is unrealized? That means it's something that has not yet happened. So in the case of investments and capital gains, that just means that you have an investment that you bought and have not yet sold. And that could be unrealized gains, or it could be losses. It could be an investment that's gone down in value. Okay. And so that's what we're thinking about at the moment, that there could be some opportunities for those folks who bought crypto 6-8 weeks ago. You know, you bought the Bitcoin, now it's down by a third. Hey, this could be an opportunity to harvest what we call harvest a loss. You know, we're like farmers over here. We harvest losses, we sell things. It goes from unrealized to realized when you make that sale. So in other words, it kind of makes it official. And then that loss is available to offset other gains.
That's the key.
That's the key.
So
what do you mean, Joe?
So if I don't have any gains, I've got this loss of 33% on my Cristo.
Well, no, that's a Crisco maybe. I don't know, but not Crisco.
My Bitcoin crypto. And so I've got this loss, but what do I do with it?
Well, what do you do with it? So you have a couple of options.
Tell me.
You know, look, hey, the market has done pretty well this year, Joe, so far, and we're keeping our fingers crossed, and we're going to continue the rain dance and hope that it continues through the end of the year. So we will assume that there are also some gains in our clients and others' portfolio, our listeners out there. So if you have some gains in taxable accounts, again, what we're talking about now applies only to taxable accounts, not 401ks and IRAs. But if you have gains in those accounts and you sold your Bitcoin or whatever else type of investment you may have had and you sell it, you realize that loss, you can then realize a gain. You can sell something that's up and not pay tax.
There you go.
On the gain.
There you go.
To the amount of the loss. So let's give an example, Joe.
Please do.
Okay. So I put, hypothetically, let's say I put $30,000 into a Bitcoin ETF a month ago, and now it's worth $20,000.
Got it.
It's down how much, Joe?
$10,000.
$10,000. You're on it.
I'm paying attention.
There's all no tryptophan.
No, I was just thinking the same thing.
Yeah, that's right. So you've lost $10,000. You say, okay, this is an opportunity because I heard those guys from Certified Financial Group talking about I'm going to sell it, and I'm going to put that $10,000 loss in my hypothetical bank, okay. For investments.
Got it.
Now I've got a $10,000 loss. Well, hey, what if I look at some of the other investments that I own, maybe some mutual funds that have gone up in value over the last year, 2 or 3, and I say, you know, I think I'm going to need some money next year to do some projects that my wife wants to do. I could go ahead and sell and realize $10,000 in gain and not have to pay any tax.
Tax-free gain.
Beautiful thing.
Tax-free gain.
So the gain, let's say I sell another investment that I bought for $20,000 and it went up to $30,000. That one has a gain. I sell it. I realize, again, it goes from unrealized to realized. I realize a $10,000 gain.
Right.
Now, when it comes tax time next year, I'm going to get my 1099 from the Charles Schwab, let's say. And it's going to say, hey, Chris, you sold Bitcoin, you lost $10,000, you sold this other fund, and you had a $10,000 gain. Well, you put the two together, and what do you have?
Zero.
There you go.
So you have $10,000 of profit you've realized without taxes. Now, the benefit of this is you can reset, right?
Well, that's right. And if you don't need the money, good point, Joe. So tell us how that works.
That's why we're here. So you have this investment that you have the gain in. So you've got locked in, got your $10,000 tax-free profit, and now you can turn around and rebuy that and reset the basis.
And what does that mean, Joe?
That means that you're going to buy it at today's value, and then when you go to sell it, you've got today's value, not what you bought it a year ago, 2 years, 3 years, or 5 years ago. So you've reset the basis to today's value, which is even better. But the other thing I think we need to tell our listeners, for those of that may not be as astute as you and me,
do tell. Speak for yourself.
About locking in the wash sale rules.
Well, the wash sale rules. So all that says,
right? I want to get back in Bitcoin. You know, it's going to do good.
Well, that's right.
But
and it probably will.
And what happens?
You know, but
what happens?
Here. So the wash sale rules, and this doesn't have to do with laundry, but the wash sale rules for investments is that if I sell my Bitcoin ETF and I capture that loss for tax purposes, I can't go and buy that ETF the next day and claim the loss.
Right.
I have to be out of it for how long, Joe?
31 days.
31 days. There you go. So a month and a day, I have to be out of it. And then I can buy it back. And if it goes down further, if it goes up, I'm okay. But if I buy it back, within that 31-day window and I try to claim a loss, I'm not allowed to. It's called a wash sale.
Now, what happens if I have more losses than I have gains? Can I use it all? Do I lose it? What happens?
Well, let's just take our example and pretend that we didn't sell anything for a gain. Okay. So we lost $10,000 on our Bitcoin ETF. Mm-hmm. And we get to the end of the year and we say, well, that's the only gain or loss that we realize. So we have a minus 10,000 gain for the year. Okay, in other words, lost 10,000. So at tax time, I can deduct $3,000. I was going to say I can offset any other gains, but in this example, we don't have any. And then deduct $3,000. So in this example, if I had no other gains, and I have a $10,000 loss, I can deduct $3,000 and I keep that $7,000 in the bank, if you will. It's called a capital loss carryover. I keep that in the bank, let's say, until next year, and then I can offset gains next year. If I don't have any next year, then I can deduct another $3,000. So the rule is you offset gains first, and then another minus $3,000. I wonder if that'll ever get indexed up.
It's been like that forever. As long as I can remember.
Yeah, I mean, it should be like $10,000.
It's like the gain on the sale of your house. That hasn't changed either. They don't index any of that stuff.
Yeah, there you go.
So that's the wash sale rules and its opportunity this time of year. We're doing that for our clients on a regular basis now, looking at what the gains and losses might be and taking advantage of that. I think the other thing we want to talk about too, Chris, just on me, is that, the drop in share prices at the end of the year because capital gains and dividends are distributed.
Well, that's
what happens. So some people see the big drop overnight in the value of their shares. Why does that happen there?
Why does that happen? Well, when a dividend pays out, the share price gets reduced by that amount. Mm-hmm. And so a lot of times people will be confused by that. They'll say, hey, I had a mutual fund that was worth $10 a share and I got a dividend for $1 and I don't understand why the share price, the stock market went up, but my fund went down by $1. Right. Why is that, Joe?
Because the gains were distributed to you. And then if you've been reinvesting, at the end of the day, you have more shares at the lower price, but you haven't made or lost any money. So that distribution is paid. That's what happens. I want our listeners to know when you see that decrease in the value of the shares, particularly at the end of the year, it's because the gains have been distributed to you, the dividends have been distributed to you, and that's what impacts it. But if you're reinvesting, you're going to buy more shares at the lower price. At the end of the day, you haven't made or lost any money, so don't panic when you see that share price go down.
But that is a perfect segue into... You like that?
I like it.
Into, hey, some mutual funds distribute more gains, and guess what? In taxable accounts, you pay tax on those distributions, right?
Yes, you do.
And this is where the ETFs are a much better wrapper.
More tax efficient.
For investments, more tax efficient.
For sure.
So not as big a deal in retirement accounts, but in taxable accounts, it can be a very big deal.
Got it.
So we still have time, Joe, we still have time for our listeners out there to check your mutual funds in taxable accounts and see what the anticipated distribution rates are. Sometimes people get big surprises, and the challenge becomes when you have a large embedded gain, you have a large, to our last topic, unrealized gain in a mutual fund where you go, geez, this thing's going to distribute a big dividend. I wish I could get out of it before that happens and just buy a comparable investment. But oftentimes the rub is, hey, if I've owned this investment for a while and I have a big gain built up in there, it's not so easy just to sell it and realize the gain. But look, this is where planning comes in, right? These are the things that we look at and we consider, do you have losses out there? I can't tell you the number of clients that I have been working with, another topic here, but Roth conversions, where we're looking at, okay, do we have losses from prior years? Where is our income this year? And if this year, the markets are up, third straight year in a row.
Yep.
So most investments are up in value this year as well as the last couple years. And so if you're doing any rebalancing at all, there are some gains to be realized, but this is where offsetting those with losses that could be out there, but also being aware, Joe, to your point, of the dividends that are paying out and how that's going to affect your tax situation is important. And it's something that I believe it's better to be proactive about and at least be aware that it's coming, to determine if there are other things that you may need to do, adjust, or even wait on in the way of distributions, if those distributions are going to impact your overall income and potentially bump you into a higher tax bracket.
Without question.
Yeah.
So those are all the things that Chris and I and the 15 other certified financial planners do for our clients. It's looking at your tax situation, because a tax dollar saved is a tax dollar earned.
When you think about it, Joe, taxes are really one of the few things we have control over. The amount of risk we take in our portfolio, the amount we save.
That's a good point.
And then taxes, to some degree, I say control over. We can control when we realize gains and these kinds of things, but we have more control over that, certainly, than the direction of the market.
Yep, without question.
So, it's something that we spend a lot of time on here in helping clients understand their tax situation. And hopefully our listeners out there have their finger on the pulse of their situation.
So if you want more information about what Chris and I and the 15 other certified financial planners do day in and day out, providing retirement planning, investment management for a fee, you can go to our website. That's financialgroup.com, financialgroup.com. And coincidentally, Charles Curry is taking calls off the air today for you. So if you want a personal consultation with him, you can reach him right now at 407-869-9800. That's 407-869-9800. And I think I hear the bumper music. Josh, take it away.
You sure do. And Charles Curry is always great to have in your corner, because if you need your own private episode of On the Money, Charles Curry is hosting that right now for you at the number that Joe Bert just mentioned, 407-869-9800, 407-869-9800. You're listening to On the Money, where we're planning tomorrow.
Today.
Welcome back to On the Money. We got Joe Bert and Chris Toadvine here answering our questions. If you want to send one in, by all means, open up that WDBO app and send in your open mic for a future episode of On the Money. We got Joe and Chris today. Gentlemen, how are we doing?
We're doing great.
Doing good, Josh.
Good to be with you, Josh.
Yeah.
And we're talking about year-end tax planning before we took the break. And so Chris has another couple points he wants to hit on, Chris.
Well, that's exactly right. And Joe, I'm gonna do a little audible. So this is most things have a tax implication, but we're gonna say these are questions that need to be answered before year end. And this next question is something that is going to apply to those of our listeners out there who are, let's say, over 70 and a half, in many cases 73 or beyond, okay? And that question is, are you subject to taking an RMD?
Which stands for?
Required Minimum Distribution.
Which means?
What does that mean, Joe?
It means that when you reach a certain age, now age 73, the government says you need to start withdrawing from your retirement accounts because you've had all this tax accumulated benefit of money growing without being taxed. That's what tax accumulated benefit means. And now they want their share of it. So government says based on your age, you have to withdraw so much money out of your account.
And that's correct. And you know what, Joe?
Tell me.
I realized that I misspoke here a moment ago.
Oh.
Because this doesn't just apply to that age group. That's distributions, RMDs from
required minimum. Yes,
required minimum distributions from your own account.
Right.
I lost my dad last year.
Oh yeah.
Yeah, and I have to take a distribution from his IRA this year. So you know what? I'm not in the group we were just describing, but there's lots of people out there who have lost a family member, friend, whomever, who might have left them a retirement account. And in some cases, Joe, we're even seeing now a second generation,
right,
where the person who originally inherited it has passed on and they left it to someone. So the point being, let's just clean that up a little bit. Required minimum distributions apply to lots of folks. If you're over, let's say, age 70, it's likely going to apply to you. But if you're under that age and you've inherited an IRA, it's going to apply to you as well.
That's correct.
And when do those distributions have to come out, Joe?
They all have to be withdrawn within 10 years. So you got 10 years to empty the bucket.
That's right. On the inherited, but required distributions from a calendar year standpoint, when do those have to be out?
No later than April 1st of that year in which it starts, and then you have to take 2 that year, but it should be by December 31st if you don't want to have perhaps a big tax.
Let's assume someone started. When does it have to be out?
Assume
Try one more time.
December 31st.
There you go. There you go. You were overachieving on the question, but
it's a tryptophan kicking in.
Yeah. All that turkey's catching up with you, or pumpkin pie maybe. But nonetheless, yeah, so they have to be out by the end of December. So we have right at a month. And so it's important, and I know we've been working all year, really, with our clients to get those distributions out and processed. But some of the ones that can be a little more tricky are folks who are taking distribution, where they set it up a few years ago to take $500 a month, and that was enough then, but now they need $700 a month because their account value has gone up. So now is the time, folks, to do the math, double check, make your list, check it twice, and be sure that the amount that you've taken out already has you on track to take enough out to satisfy the required minimum distribution. If you have questions about that, again, Charles Curry is available for calls right now. He can help walk you through that in more detail. But it is something, because, Joe, what happens if someone forgets or doesn't take enough?
Well, you got to pay taxes, a 25% penalty right now.
Right. Yeah. So and it used
plus
to be
the taxes, 25. Yeah, it used to be 50. It's 25% now, plus the taxes that are due, which makes it very onerous. So you need to be working with your advisor to be sure that he or she is on top of this, and to avoid that kind of situation. So
and let's think about those folks who maybe still have retirement accounts out there, and by that I mean 401k, 403b. And they've stopped working, so they have to take a required distribution, and they have 2 or 3 retirement 401k accounts out there. Can they take it all out of one, Joe?
No. You can aggregate your IRA accounts, but you can't aggregate your 401k and non-IRA accounts. So you have to look at each individual 401k and take the deduction. And, of course, that's really shows why you want to consolidate this when you retire, to get all those retirement accounts into one IRA.
That's right. Makes it a lot easier administratively, easier to manage. 1099, not 3. So lots of benefits to consolidate.
Right.
So these are some of the things. But for those who have multiple IRAs, can they take it all from one?
Yes. Yes, if they have multiple IRAs, you can take it from one IRA, but you can't aggregate your 401k plans.
There you go.
Yes, that's the way the numbers work. Yep,
That's how it works. So yes, as we come up on the end of the year, that's very important to be sure, number one, you know how much you need to take out. Number two, that you've taken it out. So I'm hearing some bumper music. Josh, take it away.
Thank you so much. Chris Toadvine and Joe Bert getting us through another great episode of On the Money here on WDBO. Also, we got Charles Curry taking calls off the air. Pick up the phone, dial 407-869-9800. Tell them you were listening to Joe and Chris on the radio and wanted a little bit more info. Again, Chris Toadvine, Joe Bert, you're listening to another episode of On the Money, where we're planning tomorrow
Today
with the Certified Financial Group. Welcome back to On the Money here on WDBO AM 580, always streaming inside your WDBO app. We got Joe Bert, we got Chris Toadvine, two certified financial planners with the Certified Financial Group, getting us through this post-Thanksgiving episode of On the Money, the tryptophan-sponsored episode of On the Money. Hopefully we woke up from our naps and we're ready to take in some financial knowledge. Again, Joe Bert and Chris Toadvine, if you want to join the conversation, we got open mics for you available inside the WDBO app. We also got Charles Curry taking your calls off the air right now. Pick up the phone, dial 407-869-9800. 407-869-9800. Take it away, guys.
So some of those listeners that may be just joining us, we're talking about year-end tax planning, things you ought to be considering looking at to minimize your tax situation for 2025.
Yeah, that's exactly right, Joe. So we talked about unrealized gains and losses and the opportunity that could be there if you have unrealized losses in your taxable investment accounts, that, hey, it may be worth considering realizing that loss, and then also realizing gains to mop up the loss and reset your basis, or just take funds out if you need it, or even allowing the loss to help reduce your taxable income on your 2025 return. So we talked about that. We talked about required minimum distributions, which is something that many people are going to be subjected to, and hopefully they have already calculated how much they need to take out and taken that out. But if not, you've got about a month left, and I wouldn't wait till the end of the month, because things get pretty busy and people tend to move a little slower in terms of administration. But another big one, Joe, that we need to be very aware of this time of year, and really all year, and this is what we do with our clients throughout the year, is to think about what tax bracket, where are they income-wise, and are they on the threshold of another tax bracket? Mm-hmm. So can you think of any reasons why that would be important? Are you on the threshold of another tax bracket?
Well, it's certainly if you're considering Roth conversions.
There you go.
That's probably the big one.
Yeah, that's probably a big one. So, and I think Dave was on, last week or so,
yeah.
and he was talking about this topic extensively. So, if our listeners want a deeper dive on that, listen to last week. But Roth conversions, something I've been doing a lot more of, Joe. And with some folks, it might be $7,000. With others, it might be $75,000 or $100,000, depending on their situation. But I'll say the low-hanging fruit in every situation is different for Roth conversions. But filling, I think, at least the 12% bracket or bucket, let's say, is really a no-brainer.
Okay, now what do you mean by filling the 12% bucket?
Yeah, good question. So
that's why I'm here.
Hey, I appreciate it. I want you to feel relevant. So, the tax brackets, I like to describe it to clients, it's almost like stair steps. Mm-hmm. So, when you start off the first portion of your income, you pay 10%, and that goes up. And let's talk about married filing joint. Generally, a single person is half of the number we're going to give here. Mm-hmm. But married filing joint is up to, just under $24,000. You're at 10%, but then the 12% will be the next stair step up, right. That next amount of income from $24,000 rounded off to almost $97,000, 12% right. Tax bracket. Right. So, and then it goes up to 22 and 24 and on up from there. Right. So there are several more steps on that ladder. But when I say fill the 12% bucket, what I mean is having enough income on your return to basically have $96,000 of income. Right. Now that's taxable income, Joe.
Right.
So what does that mean?
That means after your deductions.
After your deductions.
Right.
And what are your deductions?
Well, it depends on your situation. Can you do charities? Can you do interest on your home mortgage, your property taxes, all those itemized deductions? A lot of people today take the standard deduction now because it's greater than all that other stuff combined.
That's right. So, and yeah, I heard the statistics since the Tax Cuts and Jobs Act, 2017, aka Trump tax cuts, the standard deduction went up, and now something north of 90% of taxpayers use the standard deduction. So for most people, it's going to be that standard deduction. And then what else did we get in the way of tax goodies this year as part of the OBBBA?
The big beautiful bill? We got the senior deduction.
Senior deduction.
An extra $6,000 and $12,000 if you're married filing a joint return and you're of the right age. Yes.
That's right. Yes. And if you're over 65, again, these are dependent on income.
Yep.
Right. So, but you get another $1,600.
Right.
Right. So let's think about that for a couple. Now, for those of you under 65, this doesn't apply, but over 65, a couple who got that full standard deduction plus the additional $6,000, they can knock off of their tax return, Joe, $46,700.
Not bad.
I did the math.
Not bad.
You think about that?
Yeah, that's a lot.
I mean, that's almost $50,000 of income you don't pay any tax on.
Yep.
I mean, that's kind of a big deal.
Yep.
So,
and if you're getting tips, you get another $25,000 there.
Well, yeah, I think it's like half. Is it half the tips? I know overtime's half.
I think it's up to $25,000 on tips.
Dollar for dollar.
Yes.
Dollar for dollar. Yeah. So that's that's if we have any over 65 that are getting tips. Yeah. So. For sure. So, back to our example here, if you're on the cusp of a tax bracket, let's just say a married couple over 65 has $125,000 of income.
Yep.
Right?
Yep.
And they qualify for all the deductions, and they get to knock that down by not quite 50,000. So that takes them, let's call it just under 80,000. I don't want to get too mathy here because it gets hard to follow, I know, for our listeners out there. The point being is, hey, if you have 80,000 of income, you can bring that up to 96 and still be in the 12% bracket.
Right.
That could be a good consideration for a Roth conversion.
Yep.
So that's one of the considerations. Now, what is another big and important consideration, particularly while we're on the 65 plus age group? What's another important consideration for managing income and knowing your brackets?
Well, your IRMA.
There you go, Joe.
IRMA.
You're on it this morning.
Well, not bad. It's a turkey.
Not bad. It is a turkey.
What's IRMA?
What is IRMA?
That's your Medicare.
Income-related Medicare adjustment amount is what it stands for, but it's most folks know it as an increased premium on their Medicare.
Right.
Or what that translates to for many is a smaller Social Security deposit in the bank because you're paying a higher amount for your Medicare. And what a lot of folks don't realize until they get hit with it is that Medicare is means tested. Right?
What does that mean?
What does that mean? My goodness, the questions are coming fast and furious this morning. It's a good thing I didn't do too much turkey. But
what's means tested mean?
Means tested means that the more means you have in the way of income, the higher the premium you pay. So the more income you have, the higher your Medicare premium. And that's all it means. But it can be pretty significant, Joe, in that I was trying to get to my IRMA cheat sheet. For those who, in the highest, the first rung on the ladder is about another $87 a month per person, that is, depending on income. But it goes up to, about $525 a month per person in addition to the base rate. So you're about $700. So for a couple, it'd be about $1,400 a month for Medicare premiums, right? And that's what IRMA can do. And that's what a lot of folks don't realize. Now, that said, I was working with a client recently who retired before 65. They're looking at health insurance out there. And they about fell off their chair when they got quoted a premium coming off of COBRA at how high it is. So when we say for those in the highest IRMA category, which is over $750,000 for a married couple, paying $1,400 a month, that's still, in the grand scheme of if you had to go out there and get a policy on your own, it's not horrible, but it's a big shock if you don't know it's coming. And it's a far cry from 185-ish a month that most people pay.
And you've seen it, and I've seen it when folks come in to see us for the first time, and they're so proud that they made this big Roth conversion until they realize they just messed up their Medicare premiums.
There you go, Joe.
So you got to be careful when you're monkeying around with the Roth, because you can really mess yourself up in moving yourself into the IRMA situation and create a problem for yourself going forward.
Well, that's exactly right. And, the analogy I often give is it's like navigating a minefield, So on the one hand, there are opportunities to do things within a tax bracket, but the irony, have you ever thought of this to, our elected officials, kind of rationale, that the IRMA thresholds don't line up with tax brackets?
Of course not.
That would be too easy. So
I can never figure out why we have 59.5 on IRAs.
Or 70.5.
Or 70.5.
Can we just make it 59 or 70?
Makes no
60 or 71.
I don't understand that rationale at all. Anyway.
I don't either. But no one asked me. Had they, I would have probably. It probably wouldn't be the way it is. So that's another important question, Joe. Are you on the threshold of a tax bracket? So, as we get the year in here, and sometimes folks, I had this question last week, hey, should we do a Roth conversion? And I said, well, let's slow down a minute. We have to look at income, right? We need to understand where you are. So for those out there that are contemplating things like Roth conversions, or, hey, I need to take some money out because we've got this thing coming up, and all we have are retirement accounts or something, it's worth paying attention to where you are year to date, because sometimes it makes more sense at this point in the year to wait another 30 days or so and bump it into January 2nd of next year, and that hits your 2026 taxes. Can you believe we're talking about that, 2026?
Hard to believe. So we're talking about Roth conversions. Dave and I were talking about this last week. When you do that, in order to make the numbers work for you, when you pay the taxes, you need to pay the taxes with outside money. And you want to have the total amount of the conversion going into the Roth. So if you're in the 22% tax bracket, if you take 22% off the top and you end up with $78,000 or $100,000, that doesn't work. You want the whole $100,000 going in and paying the $22,000 in taxes going out from another source.
That's the ideal.
Yes.
That is the ideal.
Yep.
Now, to that I will say, the longer it has to simmer in that Roth bucket, the more favorable it looks. But I hear what you're saying, and ideally taxes get paid from an outside source, not from the conversion itself.
Right.
So
we have time for a text question there, Josh?
I think we do. Here comes question number 1. They say, my company offers a HAS.
That's actually, I think they mean HSA.
HSA.
Yeah.
That's right.
Autocorrect.
That's why I'm
that every time.
That's why I'm the radio person, and you guys are the experts. So maybe they have an HAS too. You don't know, but they have an HSA, and they want to know whether or not they should look into that.
Well, first of all, what is an HSA there?
It is a health savings account, and it is an account, I think of it like a Roth IRA, but better.
Better.
Joe.
Yep.
You know why it's better?
I do know why.
Do tell.
Well, first of all, you get a tax deduction for the money going in.
Yes, sir.
Secondly, the amount of money grows tax-free. And thirdly, when you take it out, it's tax-free.
That's right. Tax deferred. And do you know what else?
Tell me.
But wait, there's more.
Oh, tell me.
Well, I don't have one. Our health plan doesn't qualify, but and that's unrelated to CFG, but nonetheless, you don't pay FICA taxes on HSA contributions.
Oh, that's right.
So think about that. That is because you do pay FICA taxes. Many of our listeners may not know that. You pay FICA taxes, payroll taxes, or Social Security. They're referred to as a lot of different things, but it's a 7.65 that the employee pays, and then 7.65 that the employer pays. You pay that on 401k contributions, right? So even if you get to deduct it from your income taxes, you're still paying FICA tax. With a health savings account, you don't. That said, so the health savings account is an account you can save money into. It grows tax deferred, comes out tax free as long as it's used for
medical expenses.
Qualified
medical expenses. But that's really pretty broad on what you can use it for. And the key to making this really work for you long term is that you want to have the money invested. Don't let it sit in a money market account. Get an HSA where they will allow you to invest the money for growth for the future. And then what you want to do is keep the receipts for all these unreimbursed medical expenses that you have. Keep them in a drawer somewhere. So when the time comes and you want to withdraw some tax-free money, you've got a receipt to substantiate that. So that HSAs are, like you said, did you say this, or maybe I'm about to launch it here, a Roth IRA on steroids?
Well, they're better than a Roth. Yeah. We can call it a Roth on steroids, but they can only be used for health-related expenses.
Right.
So we need to talk about who qualifies for those when we come back.
We'll do it.
Love it.
All right,
Thank you so
Josh.
much. We got Chris Toadvine and Joe Bert wrapping up another hour after this here break, and we got Charles Curry taking calls off the air. If you want to call in and get your own little radio show there off the air, he's there. He's your own personal host at 407-869-9800. Charles Curry taking your calls off the air, 407-869-9800. You're listening to On the Money, where we're planning today with the Certified Financial Group. Welcome back to On the Money right here on WDBO AM 580, always streaming inside your WDBO app. We got Chris Toadvine and Joe Bert here answering your questions. If you want to send one in using the open mic feature inside the WDBO app. We also got Charles Curry taking calls off the air at 407-869-9800. Right before the break, Chris and Joe were having an interesting conversation about the benefits and the Roth on steroids that is an HSA, but there are some qualifications for who is enabled to use that.
Yes, there are. First of all, you have to be in a high deductible medical plan.
That's right.
Right?
Yes, high deductible health plan. That's
Health
exactly
plan.
right.
Yep.
So that is a plan that basically has a high deductible. You
Right.
know what the threshold is? I don't remember. I want to say it's $4,000 or $5,000
Yes.
of a deductible. So in other words, if your plan has a $1,000 or $1,500, you don't qualify. There is a definition and there's an amount there. That's easy enough to look up, but typically folks choose a high deductible health plan because they have a lower premium but a bigger deductible. And what I tell folks, to your advice there just before the break, Joe, is hey, keep enough in cash in the health savings account to meet your deductible for the year, if you need it.
Right.
If you can't pay it from other sources, have enough in cash, and then beyond that, invest it.
Right.
Right.
You know, the HSA, I think, is going to be part of the Republicans' reconciliation. The next bill that they're trying to get through Congress is going to be addressing the medical costs. And I think they want to somehow increase the benefits on HSAs or make it easier for people to use or something. So keep your eyes open for that. And as that develops, we'll, of course, let our listeners know.
There you go. That's
So I
good.
see we've got another text question floating in there, Josh.
Here it comes. They want to know, is it too late to do a qualified charitable deduction?
All right, what's a qualified charitable deduction?
Well,
my friend?
I think what we're talking about, Joe, is a qualified charitable
Distribution.
I think a distribution. That's right. So, and it is not too late, but you have time. But as I like to say, you don't have time to waste because it has to be done by year end, and we don't want to wait till the last minute. So, how does that work, Joe?
Well, you've got to be over 70 and a half.
That's right.
And the money has to come out of your retirement account, an IRA, directly to the charity. In other words, you can't have the money come to you and then you put it in your bank account or checking account and then you're ready to check the charity. It's got to go directly to the charity. Now they could come, so it's got to, it has to, you don't want to touch the money basically.
That's right. The check will get made payable to the
yes.
charity, not to the account owner.
And what's the benefit there, my friend?
Well, the benefit is that satisfies your required minimum distribution or that portion of it that you take. So let's say, quick example, someone has to take out $10,000. They want to give $10,000 to charity. They say, hey, I'm going to give this to my church. And, whoever, Goodwill, food bank, whatever, they call us, they tell us that. We get them a form that says, hey, make the check payable to the Second Harvest Food Bank and send it to, Joe at his home address, let's say.
Right.
And then you get the check, you deliver it to them. It can also be sent to the charity. I generally recommend it goes to the individual so they can deliver it. And that way we know that the check has gone out.
Right.
So
Now, you had a circumstance, I think, last year where the check got lost in the mail or something.
the proverbial checks in the mail situation.
Yeah, so what happened there?
And you know what happened there? I found out, I was in here working on New Year's Eve, Joe.
New Year's Eve.
The 31st of December, and just, I's dotted, T's crossed for the year. And I noticed that one of my clients, who I knew we had satisfied his required distribution because he did a number of qualified charitable distributions, one of those checks didn't get cashed. And you know when Schwab decides to reconcile their books and put it back in his account, December 31st.
Oh.
So you don't want to wait till the end of the year. That's
Yes.
the moral of the story,
So-
but it's a great tool. Charity wins, you win, everybody wins. And in the season of giving, think about if you got questions, call Charles Curry, and he can answer your questions, hopefully.
407-869-9800. And that about wraps up this program.
Thank you so much, Joe Bert, Chris Toadvine, and you, the listener, have just listened to On the Money, where we're planning tomorrow
Today.
with the Certified Financial Group.